Today is Wednesday. Welcome to the Insider's Quant Room. And we're going to talk about strategy today. Everybody see my screen? These are some open positions from the morning's session. Long gold, short NASDAQ. We had one more trade in the black box, which I was not in, so I was pretty much done with my trading. But I'd like to bring it up because I think I'm going to be making a slight change. I've noticed that the trades in the euro that occur around 11 o'clock are usually not successful. So I might be pushing this back to maybe to end at 10:45, 10:50. Since this is a 5-minute chart, you can see it took the trade at 11:05. So when you have 11 as the last hour, you got to add whatever time frame you have on the chart, whatever charts you're running. And for some, 11 o'clock things slow down. Sometimes you do have a second leg in the currency markets that take it beyond 11, but usually around 11 it's markets just get exhausted. That's when the volume starts to dry up. In the afternoon, things do pick up, mostly in the stock indices where you still have, volume. Let me move over to the other computer so I show you guys what that looks like. Let me go back to TradeStation. It's easier for me to show it to you there. John V, you're back at your in front of your computer. How'd you end up doing since you left things on and left your trading platform open? All right, the best overall or the best market for volume overall representative is the S&P. So here's the S&P. I'm going to move it over to 60 minutes in a few minutes, but for now I'm going to insert. Might already have it. Do I have volume? I don't have any volume there, so let me bring in some volume. John V, go check and let me know. Here's just simple volume. So you will notice that volume is the highest when the market opens, then it comes down, and then it spikes up again at the end of the day towards the close. Okay, here's a better example of it. There's volume. By 11 o'clock, 12 o'clock, it's dead. Then it starts to pick up about 2 o'clock into the close. Okay, this is pretty consistent throughout. Now this is just S&P. When I was an equity trader, I would trade the first hour and the last hour. Now, look at the volume drop off now, today. And then it'll pick up in the afternoon. So for most of the other markets, let's take a look at the euro. Let's start it over here. See where you can see it starts to die off at 11 o'clock. That's 11 o'clock. You can see it dive off. There's at 11 o'clock. It dives off. 10:30. 10:30. So you can see it rises, then it drops off. Rises for the open, then it dives off. This was a big move here. Dives off. Runs up, dives off. Dives off, and now it's diving off. So volume is an important part of trading, not for signals, not necessarily to qualify potential follow through like a lot of systems and systems developer believe in that. I personally don't. It's very, very, very tough to, it's more of a lagging indicator. By the time you get the volume, that's it. It's blown out of all your levels. But I do like to use it to know when I should slow down or stop trading. So it's normal, even though this is the euro, it's normal for the London session to be kind of low. It's normal for most of the volume to be where the London overlaps with the US. Okay, now you can see towards the end of the day, most of the time there's no volume at all in the euro compared to the S&P. The S&P comes down during lunch, but at the end, the last hour and a half, it picks up. Here's gold. Gold is like the euro. We stopped trading gold at 10 o'clock. So in the next day or two, I will be doing some back tests and see if a pattern that my naked eye keeps, has been identifying in the euro, losing trades when it's too close to 11. If there's data to back it up, I'm going to change the time from last trade at 11 to maybe 10:45. We've already done that with a couple other markets. I think what is it? Stocks 10:30, and then we moved the gold to 10. Now the one market that can trade pretty good up to 2 o'clock is crude. And there it is. you get a little bit of a move up. There's 230. There's 230. There's 230. There's 230. It's the last hour of crude. Any questions? All right, what I want to cover today is the breakpoints and the best place to look for it, which is the crossbox. So let me move over here to the crossbox, bring the crossbox up here. I would also like to point out that if you go to the members page, there's a PDF on the crossbox user guide. This user guide was put together years ago. Everything is pretty much the same with the exception of it doesn't talk about the benchmark. No, it doesn't talk about the hot list. So I'm going to talk a little bit about the hot list. It does talk about the recurring patterns, and I'm going to talk about recurring patterns. This says 2010. It was updated in 2010, but this was pretty much unchanged since 2007. So it's been about 10 years. We had an update in 2010. I forget what the update was. All right, let me jump over to the other computer so I can show you guys what those things mean. By the way, there's a pending dynamic exit on the second contract on gold. For those of you that stayed in there. And here it is. This is the dynamic trailing stop, the RQ channel. And also on the NASDAQ. Here's the NASDAQ. Looks like the NASDAQ's going to hit. NASDAQ's showing right now 2,180 now. That was the high. 1,200. And for 1,500 it looks like for gold. All right, let me bring it over here. Before I do that, let me talk a little bit about thinking in terms of looking ahead. We have a handful of new members that haven't heard me say this before, and we've got another handful of members that have been with us for a long time. You've heard it many times before, but I'd like to go ahead and share it. As traders, some of us at one point or the other, we develop bad habits. And the best way to overcome those bad habits is to replace them with what I call positive driven patterns in our behavior. You can't, it's not like a switch that you can turn on or off and, oh, here, let me turn it on now, I'm going to do away with all my bad habits. It doesn't work that way. It takes time. So you have to have patience with yourself. One of the best medicines, for lack of a better word, to get you to break bad habits and replace them with what I call positive driven habits is when you find that you're having success. You remember that old commercial? Was it a Wendy's commercial? The two old ladies back in the late 80s, I think. They used to come in, pound on the counter and say, "Show me the beef." Y'all remember that? Well, you need some of that to break bad habits and replace them with good habits. Show me the beef. Show me the money. No, it was where's the beef, right? Was that it? And then in the sports movie, forgot the name of it right now, it's show me the money. Now, I can be, or anybody else for that matter, can be very successful at trading, and you can watch them. You can, yeah, Shane, Jerry Maguire. You can watch them, and you can try to follow them, but you're not going to have that medicine until you can prove it to yourself that you can do it for yourself. So positive driven patterns, you have to be aware of them, and it should be like a checklist every morning when you get ready to trade. When you get ready to trade, you should have, a few moments of silent, no noise, and you should think about it and say, okay, I have, these are my bad habits, and this is what I need to do. This is what I should be doing instead. What are those things that we should be doing instead? Well, one of them is the way to approach the market. And the way that you should be approaching the market is by looking ahead. It's one of the things that I find talking to traders of why they're failing is they usually follow the market from a rear view mirror. And to succeed, in my opinion, and this is what's at the center of I Newton, we need to look ahead. John V., you're a hunter. And it's part of being a hunter. Hunters don't go chasing deer. They're going to scare them away. Hunters do their homework. They're scouting prior to the season opening. So when the season opens, they know where they're going to, which creek they're going to drink water, where they're bedding, where they're eating. And it's a matter of finding that location, and you got to wait for the deer to come to you. You can't chase the deer. So that's forward looking, because the deer was at the third oak tree behind Billy's cabin. You know, that's not good enough. Trading the way that we trade is very similar in the sense that when the markets get ready to open or before they open, we've done our homework. That's what we do on Mondays. Knowing where the break points are on the major markets is key. And it's key because then when those things begin to unfold and you get signals, you can have confidence in the signals. Sometimes you're going to get signals where it doesn't really make sense. And that's where you have the option to turn it off. All right, now looking ahead, I'm going to give two examples. And you've heard these 100 times. One example is tornadoes. By the way, that NASDAQ is about to hit that trailing stop. John, you're short NASDAQ, right? John says that his gold didn't trigger, that he's short NASDAQ for $1,300. He's up $1,700 for the yen, and he took a $300 loss on the euro. John, you're not gonna. I don't know where the yen is because my system didn't take the yen. But you know what? The yen. I don't know where the signal is in the yen, John. Let me check for you. Your NASDAQ's going to get you out in the next 4 ticks. I wouldn't touch the NASDAQ. The yen has a trailing stop of, is this the yen? Yeah. The yen has a trailing stop of 3. So your yen's going to get you out somewhere around here. So I'm guessing the most you can probably give back is $300. Okay. Now, you can also just close them out now. Take your money. But, if the NASDAQ comes back to test the low, that's $2,000. So here you're going to risk what, $100 to make $800, $900? I'd keep the NASDAQ open. I'd keep them both open. John? Sal's asking, if I am flat and the I Newton is still in a trade, when's turning the strategy back on? Will it submit an order? When closing the strategies. Sal, I'm not sure I understand your question, but I'm going to try to answer it the way that I think I'm reading it. So you were in an I Newton trade, but you got out manually. If you got out manually, I believe the system will disable itself. So you would need to enable it again. Make sure that all the orders are canceled. Okay? So whenever you override the system, you need to cancel the orders. And you need to disable it, actually. If you want to take the next trade, enable it again once you're flat. But you could have some orders out there. If you got out manually, you could have some orders out there from the system. So you would need to cancel the orders. Do you know where to do that on Ninja? Okay. All right, so how are we going to, by the way, John, that's a good day, isn't it? All right, so how are we going to be able to look forward, look ahead? The example with the tornadoes. During tornado season, you have cold air coming up. I'm sorry, you have warm air coming up from the Gulf of Mexico. You got cold air coming down from Canada and the Rockies. And when they meet, it's the recipe for a violent storm. Same thing in trading. What analogy can we use for warm air coming up from the Gulf of Mexico? Direction of S&P. What can be coming down from cold air coming down from the north? Opposite direction of the S&P. So you can use the S&P and you can use 10-year notes. And when these two go in opposite direction, and you get risk on or risk off, that's the recipe for a storm. And we want a storm. What we don't want is a peaceful day at the beach where it's sunny and there's nothing going on. We don't make money. We want the storms. So we have to be like weathermen. We have to forecast. We need to look ahead and see these developments when they begin to develop, not when it's already done, when they begin to develop. So we can be ready for the trades, and also a shift so we can get out of trades. Because how many times have we been like in a risk on, everything looks great, we get signals, we're making a little bit of money, and then the sentiment changes. Get out of the trade. Or for those of you that are hands-on, exit the trade. Those are usually losing trades. But when we go from mixed to risk on, or when we go transition into risk on or risk off, those are the best case scenarios. And, we've been gathering data and following the trades, for the last month and a half. And it backs up what I'm saying. I've done those studies even further back. And it's there. You can't deny it. So we need to look ahead. By looking ahead, we watch like a slow movie these things develop, if they develop. If they don't develop, you don't want to be in the market. That will help you to develop positive driven patterns. So your brain will be reprogrammed or reconditioned to look at the markets in that way, instead of, oh, here's a signal coming up. Wow, look what You know, look what the S&P's doing. I better get in. Or here's a major breakout or a breakdown or this or that. Forget about that. Unless it's worked for you. It never worked for me. John, it's going back into your favor. Look how close. You came within a tick of getting stopped out. Look at that. One tick away from getting stopped out of the NASDAQ. So you have a good chance, John V, and those that are listening. We just saw, I just showed you the heavy volumes in the stocks in the beginning of the session, at the end of the session. So if this thing picks up towards the end of the session and you're still in it, there's a good chance they could push this even further down. We'll have to wait and see. All right, so risk sentiment is important for us to forecast so we can be ready. Knowing how these things work together, and Sal, there's a couple folks that I'm going to have to send the correlations. Matrix. Let me see where it is. Didn't mean to do that. Shoot. All right, so knowing which of these trade together is important, because if you're seeing risk off come into play like this morning, what are the other markets that should go with it? Here we go, risk off. Short stocks, long bonds, should be short crude. Crude, I don't know, it was, you had inventories day to day, so forget about that. Short copper, somebody told me copper fell off the map earlier, and long gold. And the carry trade, short stocks, long bonds, long Japanese yen. And those were the ones that moved today. So when you see the storm coming and you're forecasting, we're getting a storm. It's building up. Now you can think like a master chess player. Master chess players have regular IQs. They don't have any super high IQs. It's been, I forget the name of the master chess player and the research guy. Van Goot? I forget his name. Did the research. What makes master chess players masters is that they're able to envision 3 or 4 moves ahead of time. That's it. But they have a knack for being able to identify 2 or 3 moves. And that's the second phase. So the first phase is be a forecaster. When A and B create C, more A creates B, which creates C, then you get your explosive move. The next way to think is like a chess player. What are the 3 or 4 possible moves in the markets where I can make money? If I'm trading 17 instruments, using that approach, you'll be able to narrow it down quickly to just 3 or 4. and forget about the others. You just need to look at 3 or 4. And if they're all beginning to make sense, what I mean by that, if they're all beginning to fall into place, then you know the institutions are making a major shift. They're either putting money into play or they're unwinding positions. Today we saw unwinding positions. And it's great when you're able to see it in advance and watch it play out and be in the right instruments. Right? All right. So that's the mental aspect. That's the trader's mindset that we should exercise. The next thing to pay attention to, and not in this order, by the way, is because I skipped one area. One is the theme for the week can help. And lastly would be the breakpoints or the triggers, technical triggers in the market. Because when they do hit that, expect what? Volatility, potential follow through. Let's take a look at that. Now we can go back and look at this and go to the crossbox. Okay, so the crossbox tell us today, make sure that I'm updated here. The benchmarks is a good area to get the bird's eye view of rotation flows. So by looking at this, we know that the stocks, which had been bullish 2 days ago, 3 days ago, they had been bullish for a week and a half, almost 2, went to neutral. The notes went from neutral to a 3, which is very close to bullish. And the dollar's been bearish for 2 or 3 days. So right there is giving you a picture of rotation flows. Upside, we had Swiss franc, euro, and NASDAQ. NASDAQ didn't play out. NASDAQ was only because of the description, not the quant ranking. Downside, dollar Swiss. The other areas to pay a lot of attention to are the trigger prices. Because when these things hit, it could or it can have follow through because stops get triggered. So let's take a closer look. I got to go to the other workspace for that. All right, we're going to start with the S&P, the benchmarks. We don't even have a major break point yet on this. So we might have to go into our notes, barroom napkin notes. Do I have the latest here? Yeah. Support, well, 23.75 is a break point. Right here. It hit it, went through, looks like it came back close to testing, heading back down. Ten-year notes. This is the bigger deal, and I'll tell you why in a minute. So, as I said a little while ago, forecasting the storm when A produces B, which produces more C, which produces rather C, more A, more B, more C, on and on and on. And we start with rotation flows of the risk assets. Look, the next area to look at are the technicals. So what we had here is, hey, technically speaking, you've got a symmetric triangle on the nodes. That means that we might get volatility. We might have that tornado rip right through. Because if there's enough hot wind or hot air coming up from the Gulf, enough cold air, that's rotation flows that we saw this morning. And you got some of these markets where they're saying, hey, I'm ready for an explosive move. You got to be in it. That's what we want. That's how you trade looking ahead. You wait for it. And you're ready for it. So here we have the notes. We had a nice heads up, expect volatility. Then you can expect volatility out of gold and out of the yen. So this is the notes. Gold. And the yen. So our barroom napkin notes is going to be more updated and more intraday than the crossbox, because the crossbox is more macro, but it's still good. It's one more tool to use. So patterns are also very important, and trigger prices are very important. Let's see, for the notes we had 126.20. That one, we nailed that one. The heck did I put on there? Got the wrong one, sorry. Let me check to see where 126.20 is on a little bit easier to see on my trade station. What did I say it was? 126.20. And there it goes. And this move here, John V, is going to help you. So now towards the end of the trading session, if it picks up, if volume comes back into the market, it could push the NASDAQ down to the low. How much are you up right now? You got a new high in the yen. John V's up to $2,100 on the yen, 1,400 on the NASDAQ. So you're up, let me see what you said earlier. So you're up about $400 to $500 more. Right, John V? John V says he moved the stops to Lazy River, but it already did that for you, John V. You got to be careful that you don't duplicate your orders. Let me show you what I mean. You see this dotted blue line? That's a trailing stop. See these dotted purple lines down here? That's a trailing stop. Now this is, I believe, a 6 and this is a 7. You know, you could use the 2 and it'll be tighter, but it's going to get you out quicker. So going back to our lesson, the trigger prices, break points in the markets are important. Patterns are also important. In the cross box, when we are at resistance, we add a point. When we're at support, we subtract a point, or actually we add a negative point. Because a lot of times when they do hit support or resistance, there's a lot of volatility around it because it brings in different styles of traders, and there's usually at least a big enough move to get your stop loss to move to break even. Yeah, Mike, all these are I Newton trades. And John V was I Newton. You know, that's just the way it is. Different data providers. Sometimes you'll miss a trade. I didn't get the yen, but I got the gold. He didn't get the gold, but he got the yen. We both got the NASDAQ. We both got the euro. Here's my P&L. This was the stop on the euro, which I should have never been in. And then my open positions are 1,400 and 900. Was that about 2,300? And then another 400, about 2,700, and the day's not over. All right, let's open it up for some questions. Yeah, lazy river is a phrase that one of our moderators used to use using the RQ channel. Let me get to the other workspace to get a better view of it. John V, I take it back. I was looking at gold. Your trailing stop should be around here. Look at your NASDAQ come straight back down. How much are you up now, John? All right, here's the lazy river. This blue line is the lazy river. So you're short, so you would be moving your stop with just a couple ticks above the blue line. And that keeps you in the trade as it trends. Or if it dies out, it narrows. And you can see here. So if it just starts to consolidate, this will continue to narrow. And then it'll take you out. Oops, not there. Takes you out up here. That's lazy river. The I Newton has that's just called an RQ channel dynamic trailing stop. I Newton has it. The higher the number, the longer it'll keep you in the trade. The smaller the number, the quicker it will get you out. So we have gold and the NASDAQ as a swing trade. So one is set at 7, the other one's set at 6. The yen, where is the yen? Here's the yen. The yen is set at 3, so it'll get you out quicker. Let me change this to 3 so you can see what it looks like. There. So here's your lazy river. And it's keeping you in the trend. And pretty soon it'll start moving up like this until prices break. Then it'll get you out. So you're up now $4,000, John? 3,800? That's a nice day, huh? Questions? So this lazy river right here kept John in the trade. course, you know, Newton, we don't call it lazy river. We just call it dynamic trailing stop. And there's a good chance NASDAQ could come down and test the lows. Democrats keep coming on TV talking about impeaching the president. It'll keep pressure on the NASDAQ. The funny thing is that, or at least my view, that if he ends up getting impeached, if he does, you get Pence that walks right in who will be able to execute Trump's policies better than Trump. And then we'll see the reflation trade come right back. And hopefully, you know, we'll have the trade signals, right? And we'll be able to write it back up. Let's see. That's a little bit forward thinking. Looking ahead. But John V., you're looking really good. I'm up now nicely too. I don't know why you're up more than I am in the NASDAQ. No, you're up the same. NASDAQ, you're up the same. You're up on the yen more than I am because I got out of one with 80 ticks. So it's about the same, John. Actually, you're up a little bit more than me. All right, insiders, what other questions do you have before I close up? None? All right. John V., send me an email when you close those positions. Let me know where you finally got out at. You may have to tie your hand to the seat. I know your hand's on and you're probably going to be pulling that trigger soon. Am I right? Is that what keeps crossing your mind, John V.? You might be getting momentum into the close. Might be able to squeeze some more money out of it. All right, everybody, I'm going to go ahead and close up. I'll go ahead and upload the recording later this evening and send it out to you. If there are no more questions, I'll go ahead and close up. If any questions come up, send me an email with the question. All right, everybody. Stay safe. Bye now.